and welcome back. Today again we will deep dive on the fixed income security and some extent of legal structure again, and we'll reiterate the stuff so you would remember things. So let's start. Think of a fixed income security commonly called as a bond as a contract. When you invest, you are essentially the bank which you are lending money to an entity like a government or a corporation. In return, the issuer promises two things: to pay you the interest, which is also known as coupons, and to return your original loan amount, which is your principal at the future date. Unlike buying shares in the company, you don't own a piece of business. However, you are safer. If the company fails, you are in line to get paid before the shareholders are being paid. So we learned that bonds are debt contracts prioritizing income stability and preservation, capital preservations over ownership. So, if you see in this diagram, which is your investors, investors and lender, capital flows to the issuer. If you see, which is also known as the principal, and this is like a initial loan, and in response, issuer provides you the bond contract to the investor. First, what is the contract, which you remember from our previous session, and in next line, if you see here, coupon would be paid in various frequencies, which will go in detail, and the principal repayment at the end. This cycle represents the basic life cycles of the fixed income securities. Now, moving to the next, let's break down the specific features you will see in the term sheet. So, term sheet you need to understand this is who owes you the money, whether it is the US Treasury or a company like Ford, and and then maturity, which is like you see date of the maturity in this diagram. If you see, this is the lifespan of the loan. It could be an overnight or 30 years bond or 50 years bond. Then we have a par value, correct, which is generally referred as a currency par value as well sometimes, and also called your what you can say principal and par value capital. So there are various terms used, which is very important you remember, correct? So that's why we're reiterating this session with different terms, you understand. So this is the amount you get back at the end. Finally, there is the coupon rate, which is at what coupon rate this bond is issued. If a bond has $1,000 par value and a 5% coupon, you receive $50 a year. Here we see the anatomy of a bond object. The central box is the attributes we just discussed, like issuer, maturity, the par value, coupon rate. Below is the, you see the different types of bonds, which is one of the sovereign bonds, which is the government issue. So zero credit risk in this bond, correct? Then corporations like a Toyota or something, they are issuing this corporation, and municipalities which are issuing the bonds. All shares the same fundamentals what we have discussed, even though their risk levels are different. So it is a rigor. So bond. So let's talk about how bond is not a simple handshake or something. Correct. It is a rigorous legal agreement. The specific terms are written in a document which is called the indenture or trustee deed. You remember from the previous correct session. So this is why we are reiterating with the additional terminology. So your foundation become more solid, because an issuer or a borrower cannot negotiate with thousands of individuals investors. A trustee is appointed. The trustee is usually a bank that acts as on your behalf. They monitor the issuer to ensure they are following the rules. The indenture also details exactly where the money will come from to pay you back, whether it is a general taxes for a government bond or specific project revenue for a corporate bond. What did we say here is indenture is a rule book, and that the trustee is the referee enforcing those rules for the investors. So in this diagram, if you see the legal responsibility, first the issuer signs the indenture, he signs the indenture with the trustee. The trustee then actively monitors the issuer. It is the continuously monitoring the issuer. While the issuer pays the interest directly to the investor, if something goes wrong, investor reports to the trustee if there is any problem. Finally, the trustee steps into the in between to enforce rights against the issuer. It shows the trustee stand as the protective shield here. Now let's talk about the covenants, affirmative and negative. Okay, so within the indenture we find the covenants. Think of these as the do's and don'ts within the indenture. Affirmative covenants are administrative. They require the issuer to do things like maintain issuance, pay their taxes, and make interest payment on time. Negative covenants are often more critical for credit protections. They restrict the issuer. For example, they might limit how much total debt a company can take or prevent them from selling off the key asset. This protect you from the company becoming too risky after you lend them money. What did we learn? That covenants are a legal mechanism designed to protect bondholders by forcing good behavior and preventing reckless financial decisions. If you see in diagram, covenants on the left side are affirmative. We see that must do's, paying taxes and maintaining the insurance. So this is what is an affirmative kind of the sample here we have given, which is must do's. And on the right side, if you see the negative one, which is you must not do, which limits the new debt and restriction on asset sales. Okay, what debt they can take it and the rest any restriction on the asset sales. Now let's move to the next session is cash flow structure, principal repayment. So now let's look at the how cash actually flows. Starting with the principal, the most common structure is the bullet bond. What do you do in the bullet bond? You get a small interest payment during the life of the bond, but you wait until the very end to get your full loan amount back. And in contrast this with an amortizing bond like a home mortgage. Here every payment you receive is a part interest and a part principal. So the debt is paid down gradually. We also see sinking funds where the issuer is required to retire a portion of the debt early, reducing the risk of a huge payment at the end. Why did we do this? The principal repayment is not always a lump sum. It can be spread out to manage the risk. So let's look at the diagram, simple diagram. If you see the bullet structure, the state remains interest only for the most of the bond. If you see here, and transitioning to a lump sum principal payment only at the very end. The bottom part shows sorry, not bottom part, other part shows the lump sum the amortizing structure. Each state involves paying part interest and part principal, leading gradually to a zero balance without a massive final repayment. So that is what you need to understand the difference between bullet versus amortizing. Now next, let's look at the interest or coupon structure. A fixed rate bond is a predictable. If it says 5% coupon, you get 5% every year regardless of the economy. A floating rate note, which is sometimes referred as an FRN, is different. Its coupon moves up and down. It is usually tied to a benchmark like LIBOR plus a spread. If market rates rise, your coupon rates also rises. Finally, there are zero coupon bonds. These pay no interest at all. You buy them cheaper at cheaper rate. Sell it at $80 and get back $100 at the maturity. Your profit is entirely the price appreciation. What did we know here is that coupon structure determine your exposure to change interest rate changes. Fixed locks you in. Floating adjust with the market. So diagrammatically, if you want to see that how market change impact your base, market changes affect your coupon structure. If we assume market rates rise, let's assume it the scenario where market rates rise, your payment remains unchanged. Okay, if you follow the fixed arrow where the you say that my market rates not changes, your pay so your cash flow remain constant and unchanged. If you follow the floating arrow, which is this one, your payment increases, correct, when your what you can say your payment increases, protecting you from the inflation if market rate rise. And if you follow this 0 1, you rely solely on the principal price appreciation. So this highlights the different risk and rewards of the each structure. Now let's talk about the contingency provisions embedding options. So sometimes the schedule we just discussed can change. These are contingency provisions or embedded options. A callable bond gives the power to the issuer or borrower. They can call or pay off the bond early. They usually do this if interest rates fall, so they can refinance at a cheaper cost. A putable bonds gives the power to you, the investor. If rates rise, you can put or sell the bond back to them and reinvest somewhere else, so you can get more interest or more coupon. Finally, convertible bonds let you swap your debt for equity shares in the company. So in the diagram, if you see, the top row shows the issuer owns the call options, or issuer means borrower call option, and it points to that failing rates. Okay, if obviously if a borrower go into the market and it see like interest rates are falling, then he certainly pay you back your the bond, because he is already paying the highest interest rates. So rather he would pay you back and then go and reissue new bond which is lower rate, correct? And if you see the middle diagram, investor, as an investor, you, if you are investing, owns the put option pointing to the rising rates. If rates are increasing in the market, so this would benefit for you. Why do you take a lower coupon during the entire tenure? You rather sell it, this put this bond, and free yourself from that bond, and go back to the market and buy another bond which pay you more coupon. And then third one is the convertible options, which leads the equity or share. So if you see like you want to convert your bonds into the equity, so this is all written into the indenture. That is what you need to understand. Now move to the next one. uh, so let's wrap up. We have seen that the fixed income security is defined by its contractual obligation. We moved from the basic features like maturity, par value, which is principal, to the legal backbone of indenture and covenants that protect your investment. We also explored how different cash flow structure and embedded options change the risk dynamic. Understanding this foundation is critical before we can calculate prices or assess credit risk. Our final diagram summarizes the entire module. The central concept of a fixed income security splits into two main pillars: the legal contract and the cash flows. The legal side branches into the indenture and covenants, the rules. The cash flow side branches into the principal, coupons, and options, the money. This visual map reinforces that you cannot understand the money without understanding the rules. So that's all. Thanks for watching. And at the end of the module, I want to suggest please go through the books which comes with this training session. Trainings. Thank you. Thanks for listening. I'm stopping now.